So imagine selling a rental property and instantly losing 1/3 of your profit to taxes. Well, that's what happens to most people in California unless you know about the 1031 exchange. Hey, John here. Let's grab a cup of coffee and talk about something that sounds complicated, but actually is a huge wealth building tool if you own investment property, the 1031 exchange. Now, don't let the numbers scare you. 1031 just refers to section 1031 of the tax code. And what it does is actually pretty simple. It lets you sell an investment property and buy another one and allows you to defer the taxes on your profit. Now, notice I said defer, not avoid. You don't pay right now, but you do get to keep that money working for you in the meantime. The IRS spells it out like this. Gain or loss is not recognized when businesses or investment property is exchanged solely for business or investment property of a like kind. Now, when people think of investment property, they usually picture a big apartment building or a shopping center. But the truth is, lots of different types of real estate can qualify for a 1031 exchange, even ones you might not think of. For example, a small warehouse you lease to a local business is an investment property, even though most folks just see it as an industrial building. Same thing with vacation rental or Airbnb. If you're renting it out most of the year and you're using it for income, the IRS considers it an investment property, and it may qualify for a 1031 exchange. Now, overlooked examples include raw land you're holding onto for appreciation, rental shops or office condos that you lease to professionals, or even a self-storage facilities. The bottom line here, if the property is primarily held for business or investment, not personal use, chances are it can be exchanged under section 1031. That's why it's worth asking the question before you sell, because you might have more options than you thought. Now, before we go deeper, hit that subscribe button and turn on the notifications so that you don't miss more practical real estate tips like this one. Here's why it matters. Normally, if you sell rental property, Uncle Sam is standing at the door with his hand out between federal capital gains taxes, the 3.8% net investment tax, and California's steep rates, which can go up to 13.3%. You could easily lose 1/3 of your profit in taxes. Example, you sell a rental in Upland for $1 million that you originally bought for $500,000. That's $500,000 gain. Between the IRS and California, you might owe around $200,000 in taxes. But with a 1031 exchange, you roll that $1 million into another property and pay zero taxes today. That's money that keeps building wealth for you. So here's the basic playbook. Sell your investment property at closing. The money does not go to you. It goes to what's called an qualified intermediary, or QI. Day zero starts the clock. You now have 45 days to identify in writing up to 3 possible replacement properties, and that's called the identification rule. Third, by day 180, you must close. That's 6 months from the day that you sold. If you miss that deadline, even by 1 day, the exchange fails and the taxes come due. Think of it as a relay race. The baton, your money, cannot touch your hands. It goes straight from your old property through the QI and into the new property. Now, if this is making sense so far, go ahead and like this video, and if you know someone who owns rental property, share it with them. They'll thank you later. So let's hit the main rules so that you don't get tripped up. Like-kind property, pretty broad. Now, you can sell a duplex in Rancho and buy a strip mall in Riverside. Now, what doesn't qualify? Your personal home, a flip project, or anything outside the United States. Qualified intermediary, you can't touch the money. Your QI holds it until you close, and it can't be a realtor, attorney, or accountant if they've worked for you in the last 2 years. Reinvest all the proceeds. If you take cash out, that's called boot, and it's taxable right away. Now, since most of us are here in California, here's the wrinkle. California honors 1031 at the state level, but they have what's called a clawback rule. The clawback rule is California's way of making sure it eventually collects taxes on a property that started in California. And here's how it works. If you sell a California property and you do a 1031 exchange in another state, let's say you sell in Ontario and buy in Phoenix, California will let you defer the taxes today. But they don't forget that gain. Each year you have to file a Form FTB 3840 to report it. And when you finally do sell that Arizona property, California will claw back its share of the original tax. The nickname clawback comes from the idea that the state is literally reaching back or clawing back into the past transaction to collect taxes it's allowed you to defer. Now, it's not extra tax. It's just California making sure it eventually gets the tax money tied to that original California property. Let me give you two quick stories. Carlos in Santa Monica inherited a small building in the 90s. By 2023, it was worth $2.8 million. He could have paid $600,000 in taxes, but instead used a 1031 to buy a 24 unit in Riverside. Taxes deferred, more income, smarter move. David in Newport Beach sold his commercial building for $3.2 million. He identified 3 replacement properties, but couldn't close within 180 days. And on day 181, the exchange failed. The bill, $800,000. That's why deadlines are brutal. Plan ahead. Now, here are the big landmines I see people step on and some stories to show you why they matter. Touching the money, even accidentally. A guy I worked with once thought that he could hold the sale of the proceeds in his account for just a few days until the next deal was ready. He didn't mean to cheat the system. He just thought that, well, he was being practical. But the IRS doesn't care about intent. The second the money hit his bank account, the 1031 was dead. Instead of rolling all the equity forward, he got hit with a massive tax bill. One little mistake, touching the money, cost him 6 figures. 2, waiting until the last minute. Think of David in Newport Beach. He sold his building and figured 6 months would be plenty of time to line up the replacement, but real estate deals don't always play nice. Financing got delayed, sellers dragged their feet, and before you knew it, 180 days came and went. His exchange failed and he owed $800,000 in taxes. Deadlines in real estate are like gravity. They don't bend. If you don't plan ahead, you fall hard. 3, forgetting California paperwork. Now, I know a landlord who sold in San Bernardino and exchanged it into a property in Phoenix. He did everything right on the federal side, but he had no idea that California required him to file Form FTB 3840 every year to track that deferred gain. 2 years later, the Franchise Tax Board came knocking with penalties, interest, and a big estimated bill. The look on his face when he realized it wasn't optional, priceless. California does not forget. 4, ignoring boot. Boot sounds harmless, right? But boot is just IRS speak for anything that you take out of the deal, cash in your pocket, or even money that you're going to pay down debt with. I had a client who thought, I'll just keep $50,000 from the sale for personal expenses and roll the rest into the exchange. He was shocked when the IRS sent him a bill on that $50,000. He didn't break the whole exchange, but that piece became taxable immediately. Boot is like sneaking snacks out of the kitchen before dinner and then somebody notices. So here's the bottom line. A 1031 exchange isn't magic. The IRS is crystal clear. Taxes are deferred, they're not eliminated. But if you play by the rules, it lets you use the government's money to build your real estate portfolio quicker. Now, I'm not a CPA or a tax attorney, and I can't give personal tax advice. Everyone's situation is going to be different. So if you're even thinking of a 1031, your next step should be to sit down with a qualified tax professional and map it out. Done right, a 1031 exchange is one of the most powerful wealth building tools available to you in California as a property owner. Now, before you click away, make sure that you subscribe and turn on notifications so that you don't miss future videos that actually help. And if you found this valuable, share it with a friend who's looking to potentially sell a property or has investment property. They'll thank you later. Thanks for watching.